We are starting with a question here from Natalie, who's in Toronto. Good evening.
Hi, good evening, Mark. Thanks for taking my call.
Sure.
Mr. Burrows, you're my favorite analyst ever. I'd like to ask you about American Towers. I purchased it with your recommendation. As you know, it's doing extremely well. I'm just concerned, and I'd like to have your opinion if it's something that I can just tuck away, or should I sell? So I'd like to get your opinion. Thank you very much.
Sure. So American Tower has been a real success. This was the company that owns cell towers really around the world. About 67% would be in the U.S. And a couple of years ago converted into a REIT, which is a little unconventional for a REIT, but ultimately it's like apartment buildings you can just keep adding floors to. As the service providers continue to add equipment, as data use goes up, they just get more and more revenue. We think that this is a great company. We think you're going to continue to see very high dividend growth going forward. Stock's just broken through $100 over the last couple of weeks and made a new high. Certainly, I never get nervous when a stock's hitting a new high. Every shareholder's happy. There are no built-in sellers. They have a positive runway going forward. Earnings this year probably be up about 22%, 15 or 16% the year after that. We like this. We think that there's lots of people looking for growing cash flows and growing dividends. That'll be a theme tonight. It's possible to build portfolios that give you a decent yield but grow the dividend 15 to 20% a year. And this is a company that fits in that bucket. So they have lots of opportunity to continue to consolidate. We do understand that they plan to spend less money over the next couple of years, which means that they'll be able to grow their payout more substantially and more rapidly. So this is one that we hold and are likely to continue to hold unless something dramatic changes.
There you go, Natalie. Thumbs up on American Tower. Thanks for that. Ray's in Burlington, Ontario. Go ahead, Ray.
Mr. Burrows, could you give me your outlook on Paramount Resources? Aside from the low oil and gas prices, are there other reasons for the big price drop lately? Thank you very much.
So Ray, I think you're probably not alone in wondering about energy companies. This has been a sector really that's taken it on the forehead since July. Actually, the stocks started to fall well before the price of oil did, but ultimately, generally, stocks foretell, moves in commodity prices. I'm not going to separate this one from the sector other than to say this is a tough neighborhood to be in. I think that there is no indication that the weak pricing in energy is about to abate. In fact, if you look at the entire commodity complex, we've been talking for about a year or 18 months about the fact that it's a sector where the tide's going out. Commodity prices are dependent on the last dollar of demand, and if production is growing more quickly than supply, then you have a problem. And we're going through the greatest oil boom in the history of the U.S. So it's not to say that these stocks can't rally. There will be fierce short covering rallies, I think, along the way. I wouldn't know when to pick a bottom. We don't pick bottoms. The only thing I would say to you is this. When you're in a bull market, and we are, you want to own the things that are working now, because you don't get these environments very often. And to try and pick a bottom in resource stocks right now, I think, is a dangerous bet. I won't tell you that I think Paramount is better or worse. I just think it's a bad neighborhood. And I would be careful here, especially leading into year end. You're going to get some tax loss selling in some of the positions that have not worked out well. And I think people have loaded up buying the pullback and may wind up having some second thoughts as they get toward year end.
What about pure natural gas players? Do you look at them differently or the same?
They're all different. But the reality is, whether it's coal or natural gas or crude, right now you're in a tough neighborhood. Mm-hmm. And if you think that the U.S. dollar is likely to continue to be strong, and if you think that China continues to have headwinds, and if you think that the U.S. is going to continue to mass manufacture inexpensive energy, which is what they're doing with these new technologies, then there's very little pricing power for these suppliers. So I would just be careful.
Okay, David, still in this sector, Tony's in Toronto. Go ahead.
Thank you for taking my call. I know you probably won't be positive on this one. Trinidad Drilling, is it possibly going to go lower? And they came out today that they're going to buy 10% of their float. Is that a positive for the company?
Yeah.
Thank you.
Again, I think you're speculating here, and trying to pick bottoms is very difficult. just know that the drillers, as I said off the top, and the equipment companies are about the most cyclical within the energy value chain. And so somebody will pick a bottom and make $1 zillion. I just think that I don't know whether the bottom is here or whether it's 25% lower. And in the meantime, there's lots of companies that have the financial data going in their favor, and prices are acting as they should in a bull market. And you're probably better off focusing in those groups.
Thanks, Tony. Here's John. He's also in Toronto. Go ahead, John.
Yes, I'd like your guest views on Kinder Morgan for the long term.
Sure.
I know they've been sustainable, and when do they report their next earnings? Thank you.
Sure. So they aren't due to report earnings until January. In the most recent quarter, they missed by a snip. We own Kinder Morgan, actually, in some of our income funds. It's one of the few infrastructure companies in the U.S. that is not a master limited partnership, which has negative tax implications for Canadian investors. So this is a way that you can be invested in energy infrastructure. It is behaving exceedingly well. It's within a whisper of its all-time high, despite the fact what's been going on in energy. If you look at Kinder Morgan, if you look at Williams companies, they're both probably the two strongest in the U.S. We own both of them. Pays a little over a 4% yield that will grow at between 10 and 12%. So I think that this is attractive. Just understand that when people get emotional about the energy sector, like they did in the last few days of the sell-off in October, they came back and hit these stocks, even though they have very little exposure to the actual price of energy, it's just volume. I would argue that in North America, probably you're not likely to get volume growth slowing down unless you got to sort of $60 a barrel and stayed there for quite some time. So in the meantime, volume growth is going to continue. There's a potential that people psychologically could be less favorable just because it is attached to energy. And we've reduced our exposure, probably by a third or a little more because of that. But this one's one of the best performing stocks in the group, and we own it, and I think it looks quite attractive.
Okay, David, a break once again, and more questions after this.